This week I'm going to show you the UK stocks I bought, the top riser and faller in the portfolio, as well as the share tip of the week, which is a high risk growth stock listed in the AIM markets. I know it looks like I've been hit in the face or something, but it's just really sensitive skin. So don't be alarmed if you see that. According to Google Finance, the FTSE 100 is down 0.46%, the FTSE 250 is down 0.25%, and the S&P 500 is actually up 1.39%. I suspect that we've seen an increase in sentiment from the certainty around the Brexit deal. This means that since there is less uncertainty in the markets, the stocks, the future for them looks more promising and therefore shares had gone up. However, at the same time, the pound had also gained significant strength, which I believe had pushed stocks back down. This is because the FTSE 100 has a majority of their companies make money overseas in different currencies, meaning that money, they have less spending power in the UK, so therefore it's likely that stocks would drop. However, the FTSE 250 is more anomalous, although I'm starting to suspect that the FTSE 250 is becoming less domestic to the UK and is more reliant on businesses that are well diversified across the world, just aren't as large as the FTSE 100 companies. I think this is also combined with people taking profits, as after all the last 2 weeks were fantastic in the UK markets, and for some people looking to de-risk or just clear their investments in the UK after being sat at a loss for a while, it makes a lot of sense. My portfolio is up 1.61%, marking the third consecutive week that I have outperformed the markets, and things are getting really close to the indexes now. I may have finished the year up on growth-only returns of 30.55%. And technically, on paper, growth only, I'm behind the FTSE 250 by just 1%, behind the S&P 500 by around 10%, but ahead of the FTSE 100. However, this isn't money weighted. A majority of my money was put into the markets after June. And at that point, I didn't have that much equity in at the start. For instance, since inception, which was April the 7th, 2020, at that first month, I only really had £1,000 invested. Now I've got near to 18,000. So clearly there's going to be some money waiting, and if I'd invested that same money into a FTSE 250 fund, I likely wouldn't have seen as impressive returns, but I'm keeping it this way for now because I think it provides harder targets to reach. Furthermore, I've spoke to my broker, which is Freetrade. I use the Freetrade UK app, and I've asked for a CSV file, which will allow me to use this, export it to either a spreadsheet or also some software online, which I could then use to track performance more accurately. Because at the moment it's a lot of manual calculations, and I think it's time that we really expand upon that and I become a lot more transparent with performance and annualized returns, for example. The markets were only open for 2.5 days this week. I believe it was Bank Holiday Monday, open Tuesday, open Wednesday, then closed early on Thursday. This means there's limited talking topics or top topics of the week, as there aren't many companies posting results, and it's a pretty quiet period as it's a time you really typically spend with your families. So since there's limited news topics, I'm going to talk about my forecast for 2021 and what it means for UK markets, as well as even going to the point of talking about cryptocurrency or Bitcoin. But before we jump into this, I accidentally annoyed a group of investors over my own opinion on a stock analysis of GGP or Greatland Gold. My outcome wasn't even negative, but perhaps I made some mistakes, or perhaps that my analysis was flawed, but it seemed to really tick off a lot of people, and I thought this was quite entertaining. Someone had posted a link to that video on the London South East chat boards, saying, "Just found this idiot on YouTube." But it gets better, with the topic of this chat being, "Who is this wang?" I mean, honestly, this is brilliant. This provided comedy gold for me and really made my afternoon. If you don't know what the LSE chat boards are, they are typically a forum in which you can interact with other investors or with people with similar interests in stocks. You might both like the idea of Boohoo stock, and therefore you may not have anyone to talk to in real life about it, but you can jump on the chat board and there'll be others like-minded and talking about the stocks. Although it usually turns to personal attacks if you disagree with their opinions, following the FOMO or fear of missing out mentality. So they will either all join in the horde and all join in on the abuse, or they will listen to one person and their speculative ramping and go, actually, I really like this story, I'm going to buy this stock here. Now, I'm not saying this for GGP, but this is a typical example I've seen of some of the more speculative stocks on these chat boards. But this really worries me, as people can blindly follow the speculation of a stranger on the internet, which in truth has no information on the stock and is just completely speculating. I've seen things where people are like, this stock will 10 times in just 3 months. But they don't know how it will. No one can predict where a share price will be, but they're saying this so people start to believe it. And as more people start to believe it, the herd gets bigger. And that's the issue with it. And this could lead to people losing serious amounts of money. I've seen people where they've invested all their life savings into a stock tip by someone on the London South East chat board. And whilst a majority of them, at least with GGP, would have made a load of money, some that are invested in more speculative other stocks could really lose all their money. However, it can be a very useful tool if you're able to filter out the hate and speculation, as it allows you to keep up with company news, but also gauge the investor sentiment of the investors in the stock and see how they feel about the future of the company. But please, do your own research, as it really could end in tears. As for the comment thread, it's quite entertaining, and there's a bunch of individuals trying to insult me over a stock analysis I did by a viewer request, which admittedly I have had my faults in the past, but I've been called things like GCSE, Project Boy, a little boy that had his fingers burnt, and this idiot needs calling out. I mean, it gets worse on there, but I'm not going to dive too into it. However, if you are interested in this, I'm going to leave a link in the description down below, although please don't send any hate over there, as it's just not needed and they can be a little sensitive at times. Naturally, I responded with positivity by saying thank you, although it seems they didn't seem to notice, and I suspect they didn't realise it was actually me. I hope that this shows that the LSE chat boards can be a very toxic environment, and that it might not be that great for your health if you are actively engaging in the chat, simply because it could increase stress levels, and these arguments probably aren't that great for your health. I personally don't think it's worth actively engaging in the chats, as the energy, it just really drains you down. However, I do think it's a very good resource to lurk, or just to read and gauge a few key points, but not trawl on it day and night. In 2021, I think the UK markets are going to do quite well. The FTSE 100 is priced down significantly, as it is heavily weighted to these old world industries, which in this recession or pandemic crisis are the hardest hit. This has been an example of oil and gas, or even our banks. This could lead to a fairly strong year to date on the course of 2021 if they start resuming dividends and bouncing up from that recovery play. Although I also believe that the pound will continue to strengthen as we gain more certainty on the outlook for Brexit, and therefore this could mean that FTSE 100 stocks are in fact pushed down or very stagnant. As I said earlier, FTSE 100 stocks are globally diverse. A majority of their money is made overseas and in different currencies. This means that obviously they have less spending power in the UK, which is likely going to push their share price down. But at least now there's less uncertainty, or less of a possibility for a no-deal Brexit, as it's pretty much guaranteed at this point, so we don't have that force pushing us down or looking down upon the markets or adding a lot of subsequent risk. But there is still a lot of uncertainty on financial regulations, as they were pretty much unincluded in the Brexit deal. And I've not read this deal personally, but this is what I've heard from various news article reports. Furthermore, this means that our financial stocks, this might be the UK banks, UK insurers, they might be priced down significantly for the short term. And this could be an opportunity to buy, and you may gain value as we gain more certainty, or as there are parliamentary debates on whether these financial regulations should be in place or not. But this could definitely mean there's more risk in these stocks compared to where they may be seen as a safer stock in the past, at least prior to the great financial crisis in 2008. What I do believe is that the smaller to medium cap companies, and so I'm talking from around £50 million to less than £4 billion, I think these companies are going to be winners, as they make a majority of their revenue in the UK. In fact, I think they're going to have a pretty fantastic year. The rising pound means they have more spending power abroad. This could mean that if they wanted to expand out into Europe or the US, they then have more spending power to purchase assets in those respective countries. This gives them that opportunity. If they're domestically tied to the UK as well, they can benefit from our UK economy recovery. And I think this is going to be the best of any developed nation. Firstly, we were one of the hardest hit. Our economy is so dependent on services, and so that makes sense when our economy is shut down. However, that's meant in this recession period, a lot more people have been saving money. Once the pandemic eases away, I'm not going to talk about the vaccines, but once that happens, hopefully within the year, then we may see more people going out and spending and using that cash reserve as people become more confident on the outlook of the world, the economy, and then therefore we could see a huge short-term jump back up, going to a slow crawl of a recovery for the last GDP percentage. This combined with the near unlimited power of the Federal Reserve in the US, and it's unlikely they're going to stop pumping liquidity into the US markets, means that the dollar is likely to continue weakening as well. This would be great for cryptocurrencies like Bitcoin. They typically do very well when the Federal Reserve is expanding their balance sheet. And so I very much, even though I'm not invested in Bitcoin, I believe that Bitcoin will likely see a lot more new all-time highs this year. And it could be a huge year for the speculation. However, I'm not going to invest in that. That's far too risky for me. I'll wait until a pull down, and when I have enough wealth to need to diversify it into property and perhaps a very small allocation to crypto. But this will put me off investing in the US. If there's a falling dollar and a strengthening pound, that would very much concern me on FX rates. If I'm buying a stock now, I might wipe out all of my US stock gains because the pound has risen and therefore currency fluctuations have wiped it out. Once our economy has more stability and the currencies have started to stabilize as well, then I think that could be a great point to invest, and it could be as quick as 1 year time, as I think over that longer term period the dollar will start to strengthen back on the pound like it has historically. However, it means for now I'm going to be focusing on the UK markets, and in particular the FTSE 250 and AIM markets. This is because they're smaller, more domestically tied to the UK, and I'm more bullish on the UK than I am in other aspects of the global economy. Furthermore, if I had to invest in a fund for this year, I think I would go with the AIM 100. They're smaller, they've got more growth potential, they're heavily tied to the UK economy, and therefore that burst of recovery I think will go well amongst the small caps. I would love to know what you think. Do you think the UK will do quite well this year? I personally think the FTSE 100 may either do really well or it will just pretty much stagnate. FTSE 250 should do better than 100, but the AIM 100 should certainly be a fantastic winner. What do you think? Leave it in the comments down below. The top riser in the portfolio this week was Boohoo, increasing by 1.33%. I suspect their shares are slowly climbing in value prior to their trading update on January 14th, which could have been a very big period, as a majority of the high street stores were in fact closed or not trading during these holiday periods, including Black Friday and Christmas. This could mean that more sales have been funneled online to the likes of Amazon, and in particular Boohoo. Therefore, I think they're going to do well. I think investors of Boohoo share this sentiment, and this stock is likely going to be priced up over the next 2 weeks. We may see another pullback after the trading update like we usually do as investors get a little bit too excited. But I think we may see more stability. Last time it was fueled by more media articles and governance issues, but this time they have an auditor. Things are looking more clear and certain for the future of Boohoo, and so I think they may have a fantastic year and a time to buy, maybe before this trading update. I still hold 2,500 shares of Boohoo and a little bit more on my Trading 212 portfolio. And if you're interested in signing up to Trading 212, you can get a free share worth up to £100 when you deposit just £1 using my link in the description down below. The top faller in the portfolio this week was actually the best performer in the whole of the portfolio, and it's one that I don't talk too often about. It's Ashtead Group. Their shares had fallen by around 1.21% this week. And this is a stock I've been wanting to buy in the past, but every time they had dipped, another stock, maybe Boohoo, maybe Games Workshop, had then decided to fall in value, and therefore it was a difficult time to judge whether I should purchase more shares of this stock or the others. Ultimately, I think I'm very likely to be purchasing more of this stock in the coming months. There's a lot of value to be gained in the January month, in this month of January, as I think it could be a huge month for the portfolio. But after that, I think I'm going to put spare cash flow into Ashtead Group, as they are a well-run company, very diverse and agile. The position is currently underweight fairly significantly, as I only hold 45 shares, although they're currently yielding around 1.17%, and that's a lot higher than a lot of my portfolio. And despite the heavy averaging up, I'm likely going to do it, as it gives me a higher margin of safety, but also a little bit more dividend income for the future. The stocks I bought this week, I actually bought an additional share of the London Stock Exchange Group. This is despite shares nearly reaching all-time highs. Sentiment is really starting to build in this stock, even if it's ever so slight, and that's because the acquisition or the completion of acquiring Refinitiv is coming very close together, and it may end very shortly by the end of this month. Therefore, it's likely that shares are going to be somewhat increasing. I'm happy to purchase more, as my position is only 10 shares, and I had 15 shares in the past, and I'm slowly rebuilding that back up. I hope that I'm able to rebuild this back to 15 prior to the acquisition, but it may be a little bit too close. However, I'm happy to keep buying more steadily, as it is my smallest position in the portfolio, and it would be nice to have a little bit more of a substantial allocation in the portfolio, as I think it will be generating strong returns in the years to come. The other stock I bought this week was Halma, or the ticker symbol HLMA. They are a fantastic company that is really well run, and I'm sure you've heard it before. I'm very much a fan of their management and their active management style. They're happy to dispose of companies that are underperforming and acquire new ones that can increase their overall synergy. On the other hand, sure, they may be at a very high valuation with limited dividend growth. Even though it has been phenomenal for the last 40 odd years, it has been on the lower end of where they could be growing it. I'm confident in the outlook of the company. I think they can make some key acquisitions in the next few years, which will really bolster shareholder returns, and therefore I would like to allocate a larger proportion of my portfolio to them. They're also the lowest cost share in my portfolio, so if I have spare change, it's very likely I'll chuck it into Halma and build it up at the same time. And that's why I've only bought one more share this week. It's been a fairly boring week, as I am rebuilding my emergency fund, which will probably take another 30-40 days. Once that's done, then hopefully I'll be able to put more money into the markets and really see this portfolio grow. The share tip of the week is a higher risk growth stock listed in the AIM markets. This stock is certainly higher risk due to potential problems with the management. There's some speculation and shorting. Shorting is the opposite of going long. So if you're long, you're holding a share and buying it and holding it for the long term. If you're short, you don't believe in the prospects and therefore you're betting against it. They had shorters active, and they may still do. And this is due to the speculation over their CEO and chairman and various different management techniques that aren't ethical. And obviously this will not tick ESG funds. But this is a very strong business with a well-known brand image. And if there is an opportunity to buy in this year, I think now is the time prior to their trading update. Even if their share price is getting on the higher end of the spectrum, I think there's a lot more upside potential than there is downside potential at the current valuation. They have a fantastic balance sheet, zero debt and plenty of cash. Furthermore, they've had incredible earnings and revenue growth, which is more than likely to continue. This company is called Boohoo, and I really think now could be the last time to buy in this year at a stronger value. Unless, of course, this video doesn't age well and there's a lot more issues with either the UK economy, but or more in particular, the Boohoo's governance or corporate governance of Boohoo. I think this trading update on the 14th is probably the last time to buy in. It may dip significantly then if performance is low, then perhaps there's an opportunity to buy. But this month as a whole, I think could be the last time. If results are good, there's no articles from the media, then Boohoo is likely going to have a very strong run up in the year to come. Although since the markets weren't open for much of the week, I did find it difficult to find a share tip. So I hope you don't mind that I did recommend a stock that I currently hold. Hopefully next week things can change and we can find some new variety to add to the share tips of the week. Thank you for watching. I'm Foreman. Have a great start to the new year.